Jeff, for part 3 here, we're going to do a little bit of a potpourri because I've really liked some of the graphs you've put together recently, but they're in several of your articles. So we're just going to skip to the graphs. I'm going to ask you to explain what's going on to them, showcase them to the audience, and then you kind of give the overall message of the article. So the first one we're going to go to is the cautionary tale of undocumented insanity. So Jeff, just tell us a little bit about Japan and inflation. I'll pull up this graph that I really liked.
Yeah, it's really Japan insanity is that this idea that we should ignore the Japanese example because it's just Japanese. That, when the Japanese do QE and screw it up, it doesn't work. It must be because the Japanese screwed up QE. Not that QE is flawed, but that the Japanese execution of all of these programs is flawed. And when you actually take a step back and look beyond QE, what you find is not just quantitative easing. We keep borrowing every single idea that has been pioneered and tested in Japan, including something called money finance fiscal expansion, which is really nothing more than what we're talking about right now with the Biden administration. So it's the idea that, look, we're just going to ignore what goes on in Japan because we're going to assume that what goes on in Japan was only about Japan, when in fact we keep repeating their mistakes and also their results.
We're going to show 4 graphs here. Just tell us what they are, and then the punchline will be the latest inflation numbers, and then we'll move on to our next article. So what is this?
This is nothing more than standard neo-Keynesianism, which is that when you have a recession, which is a recession is nothing more than a temporary deviation from potential. Milton Friedman calls it his plucking model. There are other versions of it out there that the neo-Keynesians use. The idea is that you fill up aggregate demand with government spending and loose monetary policy to sort of fill in those troughs, right? That's really what we're doing. That's what the picture shows, is we fill in the trough. However, the next chart here, you are at risk of doing too much. You could overfill the trough if the government spends too much or the central bank becomes too accommodative, and that leads to inflation. We have too much of a rescue because it's more than the size of the deficit that it's facing. Therefore, we have an inflationary fire breakout, which we don't want because that's just as bad as the recessionary trough to begin with.
But for the podcasting audience, Jeff added a delightful flame graphic to the dollar. So I love that. Okay, so
yes,
now
way too hot. However, what if we're not in a recession? What if we've experienced a permanent shock, which is something we've talked about before, how mainstream econometric models have said there's never a possible permanent shock. No unit roots are allowed. What if we do have one? What if we end up with a permanent shock? Well, then you shovel money into the hole, but it's not really a hole. It's a lower level of output. You're not creating inflation because potential hasn't really changed. It's only the economic output that has. And so you're not really shoveling or filling up the troughs. You're just shoveling money into an open pit, an open deflationary pit, I should say.
Right, Jeff. You got to tell the audience that's just listening, what are you shoveling into that pit now?
Yes, the fiscal spending, the chart before this one, the fiscal spending actually shoves real dollars in terms of tax cuts, spending programs, shovel-ready projects, whatever it is. They're at least, the federal government is at least sending money into the real economy. What does the Federal Reserve send into the real economy? What do they use to try to fill in the troughs? Well, it's just rainbows and unicorns because there's no money in quantitative easing, as we talked about before, even in the nuts and bolts and the details. And so it's really about getting people to feel happy so that they fill in their own trough, right? If you believe that the Federal Reserve is being irresponsible, inflationary, irresponsible, then you'll fill in the trough yourself because you think the price of everything's going to rise quickly. And so I'm going to spend today what I would have spent tomorrow.
Jeff, the latest consumer price index, is the price of everything rising quickly?
No. In fact, when we look at the CPI, the latest CPI numbers, especially the core rates of CPI, well, let's start with the headline rate. The headline rate was 1.40% year over year. That's the unadjusted number, the not seasonally adjusted. Mm-hmm. And that's up from 1.36% in December, despite the fact that oil prices are up significantly higher, as are many commodities.
Hmm.
So despite the fact that oil is up, which contributes directly to gasoline prices, and of course, we all know that gasoline contributes a lot to the CPI bucket, as well as consumers' expectations and perceptions about inflation, yet there was only 0.04% increase in the headline rate. And the reason why is you look at the core rates that strip out food and energy, we have some of the lowest core rates of inflation in the entire series history for the CPI.
By that, you mean, to make it specific, not only is it the lowest since last June, core inflation has only been less in just 9% of all months dating back to 1960. You looked at another kind of a core rate without shelter, is that right?
Yeah, the
Less rent?
service is part of the economy that excludes the rent of shelter, which gets thrown into services. So we're just looking at services itself. What you see is that it's the first percentile. It's, I think there's only been 3 or 4 months total, and data goes back to 1984, where inflation has been this low. And really the point we're trying to make here is money printing, Federal Reserve, rainbows and unicorns don't create the monetary environment conducive to monetary inflation. And if you want to put it into fiscal terms, are we seeing the federal government fill in the trough? Or are they just shoveling money into the permanent shock, lower level of output, open pit? And so the CPI numbers, at least up to this point, and we're 11 months into this thing now. January 2021 is 11 months since March. And what we're seeing is things are getting worse, at least in terms of lack of pricing power. We talked about this before. The rebound from the initial shock has sort of tapered off, if not died out completely. So we're not getting any additional economic momentum and growth outside of potentially, government payments, which are not substitutes for real economic jobs and wealth. So we're not seeing any pricing pressure show up, which is not surprising.
That last point, the government can't fill in what's missing. And so we're going to segue to another article of yours where we're going to be looking at consumer credit, where the government is filling in consumer credit in the United States for a segment of the population. But if you take that out, then we see the true picture. What am I referencing? It's an article, Permanent Jobs and Permanent Job Losses. Alhambra Partners posted on the February 8th. February 8th is when it was posted. Jeff, just a little bit of background. I'm going to pull up the graph that I really love from this article.
Yeah, look, consumer credit is, you're talking about a specific segment. It's the government they took over the student loan market in 2008, late 2008, early 2009. Essentially, what's called consumer credit, at least as far as these statistics are concerned from the Federal Reserve, it's really not consumer credit, it's student loan credit. And so you take that out and look at just what's going on in consumer credit, and there's barely more in, the peak in early 2020 than there had been in 2008, which is consistent with, what we talk about all the time, the lack of liquidity, high risk, banks not willing to expand their balance sheets. And here we see in consumer credit outside of the federal government, that's absolutely the case. And of course, the other side of that is, since the federal government has gotten involved in the student loan market, because it's a non-economic institution that doesn't care about economic factors like, value, it just extends student loans basically to anybody who wants them. The price of education, especially higher education in the United States, has simply gone through the roof, even though economic fundamentals would imply costs of education decreasing by a significant amount. So we have two sides of the same problem.
So we're looking at a graph, 1990 to 2020, and it shows consumer credit in the United States, who extends credit to consumers in the United States. And from 1993, I'm eyeballing it, Jeff. I'm going to say that we've got a slope of 35%, right, up until 2008. But as you just pointed out, it's the federal government that is really going to come into the picture after 2008. So if we took out that student credit, student loan extension from the feds, I would say I'm going to call it a 30% incline, a slope. But then from 2011 to 2020, if we're looking apples to apples, I don't know, Jeff, I'm going to call it half. I'm going to say we're only increasing at about 15%. And it's a point I'm trying to make here is what you often write about. We live in a non-linear world where growth is already baked in to the baseline. And therefore, even though we have 15%, that's the wrong number, but you know what I'm saying? It's inclining at 15%-ish. That's not good enough. Unless, Jeff, let me ask you this question. Maybe it is good enough because I'm looking at the beginning of that graph, and from 1990 to 1993, it was a flat line. There wasn't any credit being extended. So, Jeff, kind of what is the right answer here? What amount of growth would be good enough?
Well, it's not necessarily a right answer or wrong answer. It's what makes up the fundamentals of any economy. In the 1990s, economy transitioned into a consumer-led system where we very much depended upon consumers buying services and goods. And so what the federal government has done since 2008 is, again, the Keynesian stimulus idea, filling in the troughs of aggregate demand. Well, it doesn't matter where we spend money, as long as we spend money, or loan money in this case. And so what they've essentially done is substituted loans for students going to universities, not really doing anything, investing in themselves is what most students would say. But that's not something it's not an economic process that happens immediately at the expense of banks who are no longer extending consumer credit to consumers who then are not borrowing to spend today. So at the very least, what we're saying is that the government is investing in children who will bear fruit 10 years or somewhere down the road at the expense of economic activity today that isn't happening. And of course, as we know, as we hear all the time about the problems in higher education, are we really efficiently allocating resources into that sector in lieu of this consumer economy that doesn't happen anyway? And so the government aggregate demand doesn't matter where you spend the money. Well, yeah, maybe it does. So even if the government is coming in and throwing cash at universities and colleges, it doesn't really help our economic situation because our economic situation has been impaired by the unwillingness of the banking system to extend credit, at least on the same terms as it had during the previous era.
So if we don't have credit coming into the economy as we previously did, maybe we can count on a demographic boom to lift the nominal economy. But, demographics don't turn around on a dime. What we could count on, maybe productivity. That's a graph that you drew in a recent article, a couple of them. And the one I'm going to highlight for everyone is called Old Numbers Show Us Why There Will Be New Checks. And in this article, you talk about jolts and productivity. I'm going to pull up the productivity graph. But Jeff, if you wanted to share anything about the latest job opening and job hire numbers, go ahead and let us know.
Well, job openings were basically flat, not really. They rose a little bit from the previous month, which was November. Jolts are months behind the payroll reports. We're talking about December. While the hiring rate collapsed, it fell by about 300,000, going off the top of my head, which is not a surprise because we knew the payroll report wasn't just negative in December. It was revised to substantially about the same level of negative. So we knew that the labor market was in trouble ending last year. So that wasn't really much of a surprise. I think the bigger surprise is the fact that it hasn't been better since then or before then. But when we talk about potential and economic potential, what we're measuring here is the BEA gets together with the BLS and says, this is what we say that the economy has worked in terms of hours. This is what you say is in terms of private output taken from the GDP numbers. We're trying to figure out how efficient the labor force is because productivity and efficiency is a key ingredient to economic supply and potential, the supply side, as you mentioned, Emil. And what we find is that really going back to the middle of the last decade or the middle of the decade before, the early 2000s, productivity kind of fell off and stayed off. And the only time we ever see productivity rise is when we get into these deep recessions where companies lay off millions upon millions of workers. Now, that's a natural economic process that's supposed to be short-lived. It's not supposed to be the only way to generate productivity because that's the way you get a labor force that stuck in a permanent shock.
And so this graph goes back to 1949, and what we experienced after 2009. This is awful.
a decade without any productivity growth, and economists in particular who can't figure out why this has been the case. And so they've come up with all sorts of explanations for it, or at least potential explanations for it, that essentially blame us. You know, it's lazy Americans who won't go back to school, drug addiction, fentanyl, all this stuff.
Yeah, no, that's standard fare if you don't want to take responsibility. Jeff, you also mentioned, though, that you're a little bit worried about the rebound here, right? We're supposed to have a very sharp rebound in productivity when these mass layoffs take place.
Yeah, businesses lay off workers, not to generate productivity. Productivity is sort of the signal of what they're trying to do, which is match revenues with costs, right? At some point, you fire more workers than you need to, then you know that the recession is over with, right? You've cut too many workers. And so the signal is rising productivity means that we expect recovery to begin from there, which means businesses will start to rehire workers, especially rapidly. And that leads to what we call recovery. What we've seen in 2020, however, is that, we had big productivity rebound in Q3, and then it sort of faltered in Q4, which is consistent with the labor data, which shows us that, we aren't even close to the recovery mechanics that we had that were unsatisfactory in 2009. And getting back to what we said before in the earlier segment, this lack of productivity across, the last 15 years or so sort of matches up pretty well with our gazelle argument, right? Where small businesses struggle, and small businesses are where we generate economic supply potential. It's where we generate, labor force absorption, where businesses that start out small, become medium, and get to be big. That's where most of our labor gains come from, at least our permanent labor gains.
Oh, I forgot to stop sharing the screen. All right, Jeff, our last potpourri article: upcoming bill cliff, refunding, recalls, rerun, reverse repo. Jeff,
I couldn't resist the alliteration.
You could have warned me.
Sorry about that.
I love the graph. I mean, there's this. I don't know. Maybe we should have done a whole segment on this article. I think there's a good stuff. We did talk about Treasury.
We talked about bills a lot before, so it's really just kind of, where are we now?
This is a really good one, folks. February 8th at Alhambra Partners, if you have a chance. I love these graphs about the min, median, and max. I'm just going to pull up one of them. And if there's anything you wanted to share from this article with the audience, please let us know.
Yeah, we're talking about bill auctions. And so there's, a bill auction, like most things, is not as simple as it sounds. There's no single price. It's, dealers, non-dealers, competitive, non-competitive bids, all sorts of things. So you have a range of prices that the Treasury sells its bills into the primary markets for. And what we find is that, or at least what's important to me, is beyond the last 6 weeks or so, where bill yields have fallen sharply. If you look back at it, bill yields at auction have been falling really since September and October. So that indicates rising demand for bills for some reason that has entered 2021, especially lately. It has met with what we know is going to be restricted supply. The latest quarterly Treasury funding statement, which was released last week, said that the cash management bill tenors are going to be eliminated entirely, removing about $55 billion in supply from the marketplace, which is one reason why you see the prices of those bills go through the roof. But again, this didn't just happen in January and February of 2021. It's been building for months.
Jeff, I think another very important point to make here, and I feel like we're picking on the Federal Reserve here, but okay. The point here you make, it's the reverse repo rate, which was put into place as a floor. Folks, if you've been following the show or Jeff's work, when the Fed says floor, sometimes they mean ceiling, sometimes they mean floor. It's hard to know. And even when it is a floor, the graphs that we were just showing, Jeff, we're seeing some rates, money rates, go below that floor. Just briefly, what is the reverse repo? Why should it act as a floor? What did the Fed expect? And yet, what's happening in the real marketplace?
Well, the reverse repo is, as the name implies, the Federal Reserve taking the opposite trade in a repo. So if I'm lending cash into the repo market, that's a repo. So from the Fed's perspective, if they're the one borrowing cash, they're doing a reverse repo. And as ridiculous as it sounds, you are lending cash to the Federal Reserve. Now, the Federal Reserve doesn't need the cash, and it has collateral because it has stuff, it has securities in the Soma portfolio. All it's really doing is giving you an alternative that says, I'm going to lend to you, I'm going to borrow from you at this rate. So why would you lend to anybody else less than that rate, right? Because if I can get it, if the Fed's paying 2% in reverse repo, why would I lend to anybody else at less than 2%? It's the Fed. It's the least risky option. It's collateralized. I get a Treasury bill and it's collateral from the reverse repo. So why would it not be a floor? Nobody would ever lend below that floor. And that's really theoretically how the reverse repo is supposed to work. You would never lend at a rate less than what the Fed is paying. Now, currently the reverse repo is set at the lower end of the federal funds range, which is at 0. And so we see bill yields begin to trickle their way down towards 0. They haven't penetrated into the negative yet, but they were negative last year, and they were deeply negative during the crisis period. But we have seen throughout history, including recent history, late 2017, for example, where we see Treasury bill yields fall below the reverse repo floor. And that's indicative of the same kind of thing, right? Why would you lend to the U.S. government, even for a 4-week term, at a rate less than what you could get from the Federal Reserve in a reverse repo, collateralized lending? So from your perspective, it is a repo. Why would you not repo with the Fed at a rate that's here, and then instead of buying a Treasury bill that's less than that? And so theoretically, it shouldn't ever happen. But yet, not only did it happen, it happened on a regular basis leading up to what we call Eurodollar number 4.
And so you're worried that this signals just tightness and that not all is well. Is that right?
Why would you do that, right? So let's ask that question. Let's investigate the question. Why would you buy a Treasury bill such that the price of the Treasury bill leaves you with a smaller equivalent yield return than you could get doing a reverse repo with the Fed? And the answer is there must be some other use for that Treasury bill that is so valuable you're willing to take a lower return on it than you could get otherwise. And of course, we're talking about Treasury bill utility. What other thing could it be used for? We know what we're talking about here. We're talking about collateral and balance sheet tools and that kind of a thing.
I don't know how to end this segment, Jeff. How should we end it? That was the end of our potpourri.
We covered a lot of ground there, I think, and so everybody catch their breath. And yes, Treasury bills, inflation, all these other things, and I think it's really about the story that's being put together. I think in the mainstream is that look at commodity prices. We talk about copper, oil, all these things are flying. Inflation is coming. It's being unleashed as we speak, and yet it's January now, February of 2021. And we're observing, first of all, there is no inflation. There hasn't been. Inflation's at the lowest rates possible. And yes, I know people hate the CPI and all this index, but you got to pay attention to the correlations when they're low, at least. When they're low, that does corroborate signs that we see of nothing but trouble and bad economy, all that stuff. And then underneath, we go to the bill yields and say, something's been going on there for a couple of months, too, that isn't very reflation-y at all, where it's higher demand for bills such that now that we're restricting supply, it's leading to a big increase in price that's heading toward the reverse repo floor. And that's not a very good signal either. And we go back to 2017, wrapping this up. When we saw bill yields fall and stay below the reverse repo floor, it was kind of a warning flag that said, this is a fragile, disinflationary, getting into a trouble period where not necessarily a crash, but you go back into these Eurodollar squeezes or these global dollar shortages, which becomes the opposite of inflation and reflation. It becomes another deflationary period.
Fragility is present. I think that would be a good way to summarize it.
Yeah,
Jeff,
that's what we're seeing, fragility.
Well, we endeavored to make it a nice, short, snappy show, and it's definitely been our longest one by far. I will talk to you again next week. I had a great time, of course.
All right, take care, Emil.